All right, guys, welcome back to accounting. So, we went over the first chapter, right? Just getting a basic information of what accounting does and what constitutes of reasons for having accounting, right? What kind of business organization, what kind of means would you have a business transaction? So, here in chapter 2, we're actually going to be diving in the concepts and what you need to know in order for you to be able to process the information and understand how we actually use accounting for the business. Okay. So, once again, we're going to talk about what the definition of accounting is. Once again, it is the process of recording, analyzing, summarizing, um, all those INGs, right? Financial data from all business transactions, okay? So again, anything that's a financial information that revolves around a business transaction or a business event, whatever it is, right, is going to be what accounting does, right? We're going to take that piece of information, convert it, and try to understand why do we need to record this transaction, okay? Now, I've mentioned it to you guys before, we are focusing on primarily financial accounting, right? We're not doing taxes, we're not doing managerial taxes or forensics, right? These are just examples of what accounting fields that they could branch out to be. But in this class, we're learning strictly financial accounting, okay? Now, again, we are looking as if we are brand new to accounting. So there are a few things that you need to know that are going to be kind of like I guess we could say like we would treat accounting as if we're learning a new language, right? There's certain words in English that we read on paper that we translate in accounting terminology to understand what this means. So once again, to receive is going to be a receivable, okay? To pay is going to be an expense, right? When we need to pay something, right? To owe something is going to be a payable, or also known as a liability, right? When we owe money, right? Another one's going to be if we own property, that's going to be an asset, okay? And then again, an obligation is going to be a liability, okay? So when we talk about these type of terminologies again, we'll go through it each scenario at a time. So this is just a little, quick little dictionary for you on common words that you will see as we go through each chapter and every scenario, right? You'll know another one like when you put something on an account. Well, it depends on what position you are. Are you selling to a customer or are you buying from a vendor? Because when you put something on an account, that's going to tell you, well, if it's a customer, it's going to be an accounts receivable, right? Because they owe me money, right? They're putting it on an account. Where if we are purchasing from a vendor, then that's an accounts payable because we become liable, right? That we owe this person money. So once again, those are going to be concepts or terminologies that we will be trying to look into because, again, when we understand accounting, we also have to understand that it is just like learning a new language, okay? There's concepts that you need to learn. There's certain calculations in order for you to understand how a transaction works, okay? So we're going to start with the very, very first one on talking about accounts, okay? So here, accounts is a systematic way to be able to record and organize your transactions based on specific account types, okay? So we have a total of 5 account types, okay? It is your assets, your liabilities, your equity, your revenues, also known as income, okay? Income and revenues are the same thing, and expenses, right? We talked about this in QuickBooks, right? When we look at these types of accounts, right? Here's a few things that you also need to know. Generally, your assets are going to be everything that you own. Your liabilities are going to be everything that you owe. Your equity is going to be your net worth. And usually these three accounts are also known as your permanent accounts because they never close at the end of a given period. Okay? So a great example is a checking account, right? Is money that you own. So that is an immediate asset. Now, if we were to close our bank account, what does that tell anybody?
You close the company?
You close the company. Exactly. So in this case, that's a perfect example why we do not close out our assets, liabilities, or equity, right? You can't close out money that you owe other people. They're still going to come after you regardless whether you owe them or not. Right? So that's the same idea here, right? You can't close out assets, liabilities, or equity. However, when we take a look at income and expenses, right? Those are called our temporary accounts. Those ones, they actually close out at the end of a given accounting period. Okay? Now, here's a great example, right? When we talk about revenues, right? Can you, if the accounting period is every month, right? You close it at the end of every month, right? For revenues, can you expect your earned income or generated income when you do a sale? Can you predict or expect to have the same revenues consistently every single month?
Oh,
No,
yes.
because you might have new customers, right? New customers who just say, hey, I want to check out your business. Maybe I'll give you my business. Or maybe those old customers that usually buy the same thing over and over decide one day, I'm going to try something new. So you are unable to actually predict your revenues because it just depends on what kind of business you are. But we also depend on the customers that we sell the products to. Not everybody's going to want or like our product. At the same time, you can't predict your customers. They can come in every day. They can come in every month. In fact, they can switch off. Maybe I don't need to do their business this month. I can do it next month, right? Revenues are something that you cannot predict. Okay? Same thing with expenses, right? Can you have an expense that happens the same exact every month?
No, thanks. I don't think so.
That's a
Can't do
trick
it.
question because yes, you can have the same amount, right? A good example would be your rent expense,
Your
right?
rent, yeah.
We call that a fixed expense. But think about it. If you rent a place for, I don't know, let's say that the contract is 5 years, can you expect to pay the same exact amount every month for 5 years?
I don't know. Sometimes you have problems. I don't know. I don't think so.
Exactly. Sometimes you have problems. Sometimes there's, an economic downfall, right? Something's going on with the economics. Something's going on with real estate, right? Or just renting in general, right? Maybe because the cost of doing business is so expensive, or that land is getting more expensive, that your landlord's going to obligate you to pay more every year. So that is where,
Coronavirus.
yes, coronavirus, right? You go out and rent a place right now, you're probably looking at anywhere from $5,000 and even up, right? And you can expect that to keep continuing to rise up, especially when you're with landlords for that long. They're always going to find every reason to raise the rent every year. Okay, whether it's financial upbringing, like whatever, you've been here for long enough, you know exactly what's going on. They're not going to give you any discounts or any extra benefits. They're going to want to get money from you because they know you're a loyal customer. They want to get money out of you. Okay, and same thing here, we can say maybe this month, right? This month of August, We don't have any holidays, right? Nothing there except for maybe an end of the summer sale, right? That's where advertising expense might not happen this month. Okay? Where in the month of July, we had 4th of July. Of course, we're going to spend money on advertising. But in the month of August, maybe not so much because we don't have a holiday, right? Where September, we have a Labor Day, right? So that's going to be an example of how you wouldn't be able to predict your expenses, because if you do it on a month-to-month basis, you just never know what's going to happen, what you need, what expenses you have to encounter. All right? And that's why this your income and your revenues, your income and your expenses is going to be the perfect way to measure profitability. And that's why we must close them at the end of the given period. Okay? Because they can give us information to predict, oh, if I have a sale in July, right, I must have a huge spike in my revenues. Okay? So that's just giving you an example of each one, but and how it's a permanent account versus a temporary account. Okay? Any questions here?
Nope.
So when we talk about accounts, the way that it is organized, right? We do have a chart of accounts, which we'll talk about in chapter 3. But how we determine these accounts is that we break it down to even further, right? So we have the 5 account types, right? And there are accounts that exist under each account type. Okay, so a good example of this, right, would be like a table of contents, right? The main chapter will be chapter 1, right? But the bullet points underneath it, the smaller concepts or the lessons underneath it, is going to be either your sub account or your contra account. Okay, so if I have an overall general account type, let's call it assets, right? Underneath that, my main account will be my checking, because checking is money that I owe.
Quite hear you. Could you
Go away, Siri. So example, checking would be a good example of a main account that falls underneath your assets. Okay? And even further, right? Let's actually do another example. Maybe I want my bank to be the main account, and then I want my sub account to be my checking account, right? And then my savings account falls under the bank, so that's going to be another sub account. So that's how we understand this right here, is what does it mean to break down my accounts into main accounts, sub accounts, and contra accounts. Okay? And that's exactly what it is, right? It's like looking at a table of contents. Each asset or each liability is going to have another account under there, and each account is going to either give more details, or it can act as a contra, which is an opposite flowing direction. Okay, so let's explain this once again. When we talk about the main account usually reflects, again, a more broken down of the account type. Right? And what that does is it flows in a specific direction, okay? So for example, when we talked about QuickBooks, right? All assets generally are debited because they increase with a debit, okay? So that's the main account there, right? Now, when we talk about sub-accounts break the main account even further into more detail. Right? So we talked about the main account being the bank, right? When we break it down even further, the bank can have 3 accounts, right? It can have your checking account. It can have your savings account. It can have your money market account, okay? And what the sub account does is it gives the main account more detail, and it generally flows in the same direction as the main account. So if my main account, which is my bank account, is usually flowing on the debit side, therefore my sub-accounts will also flow in the debit side. Okay?
Even the contra?
Well, that's what we're going to talk about now. The
Sorry.
contra, okay? The contra account, right, could give details to either or, whether it's a main account or a sub account, okay? However, the only difference here is it flows in the opposite direction, okay? So, for example, right, we talked about accounts receivable, right? Accounts receivable is when customers owe you money, right? But if one day a customer says, no, I can't pay you, or I can't afford to pay you, I filed for bankruptcy, that's where the contra account is going to come into play, right? In QuickBooks, we learned it as either bad debt or we learned it as allowance for doubtful accounts. That's going to decrease either the main or the sub account, right? Doesn't matter where it is, right? It's going to decrease it and flow in the opposite direction. So in this case, right, if my assets are normally debited, a contra account would credit the account. Okay? In other words, it will decrease the account. Okay? Right? So if you know English, the word contra, right, like contradict, right, it just means opposite. Okay? So in this case, it's going to flow in the opposite direction as either the main or the sub account. So the example I gave is if assets generally flow on the debit side, a contra account would flow on the credit side. Okay. Any questions here?
Nope.
Okay, good. Right. Then we come across understanding debits and credits, okay? When we dive into chapter 3, which is going to be after the break, the way that these were created was exactly how we see a journal, okay? A journal entry, right, will have a column on the left and it will have a column on the right, and that's exactly where these directions come from, right? When we understand what a debit does to an account, right? We always refer it as left, right? Because in this case, oh, sorry, I used right. In this case, right, we understand that debit is going to be in the left side of the column, okay? Where when we use a credit, we put it on the right side of the column, okay? Now, in this case, right, a debit and a credit could refer to both increase or positive, or it could also mean decrease or negative, okay? So in context, we never refer debit and credit as increase or decrease, right? Because in this case, it really depends on which account you are looking at, okay? If the account is a liability, debits decrease liabilities. But when we look at it in context of an asset, debits increase assets, okay? And we took a look at that in the accounting model, which we learned in QuickBooks earlier, right? So that's how we understand how a transaction truly works. When we see debit, we understand it's going to be on the left side. If we take a look at credit, we must understand it's going to be on the right side. And from here on out, never refer as debits and credits as increase and decrease, because it depends on the account that you're looking at and what account type they are, okay? So we talked about assets, right? If there's a contra account, it's in order to decrease, right, an asset, you're going to use a credit, okay? All right. Any questions here?
No.
All right. Then we're going to go ahead and come across the accounting equation. This is once again the backbone of business, right? Because the fine line is that everything that we own must be equivalent to everything that we owe and the value of the company. Okay? So once again, this is the accounting equation that you must hold dear to yourselves, because this is very important that you need to know, because this is important every time you calculate or create your balance sheet. This statement must hold true at all times. If it does not hold up, you either did a mistake or an accounting error somewhere in your books, in your bookkeeping, okay? Because this statement must hold true at all times. That your total assets, everything that you own, should be equivalent to your liabilities and your equity, which is everything that you owe plus your net worth. Okay, once again, this is the fundamental backbone of all businesses. Okay? Any questions here? Right. So, now that we talked about those concepts, let's go ahead and break down each account and let's look at what each one represents. So in this case, we're going to talk about assets, liabilities, and your equity accounts. Okay. So first thing we're going to start about is your assets. Okay. The definition of an asset is going to be everything that you own. O-W-N. Okay. Own. Anything that you have property, right? You have ownership over is going to be considered an asset. Okay. Now, how we break down our assets is that we generally categorize them based on liquidity. Now, what does that mean? How easy is it to be converted into cash? Okay. That's how we determine our assets, is going to be based on how quickly can you convert it into cash. Okay? So in the very first category here, right, under assets, there are a total of 3 categories, okay? You have your current assets, you have your fixed assets, and then you have your other assets, okay? In QuickBooks, so you have these 3, plus you have additional 2 other accounts, which I don't really count them. If you want to separate your bank account, that's completely fine. But in accounting terms, general rule of thumb is just how quickly you're able to convert it to cash. So the general 3 account categories are going to be your assets, your current assets, your fixed assets, and other assets. Okay? Now let's break it down each category. So if we understand that the concept or how we organize our account is going to be based on how quickly you're able to convert it into cash, that's exactly what this says right here. So your current assets mean it's either in its readily available form, or you can sell the product and be able to convert it into cash. So oftentimes, the first kind of accounts that will be at the top of your window would generally be your checking account, cash on hand, a petty cash drawer, right? Because those are money that already exists at its simplest form, which is cash, right? Inventory, right? That's easy. If I purchase inventory, I can go around and sell it right out to the public instantly. Okay? So that's the idea here, is that when we categorize our accounts based on how quickly we're able to convert into cash. In current assets, they're pretty much very close to it's already into its cash form. Okay. So the next category is going to be your fixed assets. Now, fixed assets, as it says already in its name, right, is going to be anything that is a property, a plant, or an equipment. Okay? PP&E for sure. Okay? When you learn, if you go into further accounting, you're going to know that fixed asset is also known as PP&E, which is property, plant, and equipment. Now, if I break it down to this, right, a fixed asset could be your property. Your property could be your land, right? The streets, the sidewalks. Anything that's a piece of land is your property, okay? Your plant is going to be your building and everything that is inside your building. So furniture, lights, lamps, desks, right? Anything that has a feature to it, right? And here's a key identification of a fixed asset is it is tangible, meaning you can touch it, right? You can definitely touch the ground, so that's land. You could definitely touch your building. You could touch your furniture, okay? And equipment is going to be any machines that help you run your business. So again, if you're manufacturing, you're going to have a machine that helps you produce those items, okay? If you need to print out invoices, a printer is going to be considered a fixed asset under equipment because you need to have a printer in order for you to print out invoices to your customers, okay? That's a means of using a machinery that is able for you to operate your business, right? In QuickBooks, if you guys remember in that little small chapter about fixed assets, it says generally fixed assets are going to be anything that is $2,500 or more and usually typically would have a life, okay? Now, in our context, since we're looking at a sole proprietor, a small business, any asset that has a life itself, doesn't matter how much the price is, would generally be a fixed asset as long as it has a lifespan, okay? So as we know, technology, if we buy a printer, right, you can't say that that printer will last you forever, right? It usually has a lifespan of 5 to 10 years, depending on how often you use it, okay? A truck is going to be considered equipment because you need that to drive, either to deliver stuff to people, drive to the venue, drive to places, That's going to be something that has a life because usually cars, right? Their maximum lifespan could be anywhere from 10, 15 to 20 years, depending on how well you keep it maintenance, but also how often you use it. If you're driving this all over across the United States, you can expect this the life of this fixed asset will definitely decrease very quickly. Okay? And we'll talk about what we do with fixed assets later on in chapter 11 when we need to calculate how much it's going to cost the business for using these assets. Okay? And then last but not least, we have other assets, which in a good characteristic of an other asset is that usually it is intangible, meaning you cannot touch it. Okay? So a great example would be prepaid insurance. Okay? Now, can you actually touch insurance?
No.
You can touch your insurance card, yes, but can you actually physically touch this invisible protection field over it? No. Same thing with a copyright, a license, a patent. Okay? Prepaid rent, prepaid insurance, prepaid anything, right? A deposit. All of those things have one thing in common. You can't touch it. Yes, there's a paper document for it, but can you touch a copyright? Can you touch that invisible protective layer over an idea? You can't even touch your own idea. So in that case, that's a double whammy right there. Not only is it an intangible, it's on an intangible thought, meaning it's protecting something that doesn't exist. Okay? So that's going to be considered an other asset because it has one characteristic, which means you can't touch it. Now, does it have a life? Of course, right? Copyrights, licenses, usually those have to be renewed. Obviously, prepaid insurance, you're not going to pay for 10 years of insurance, right? Usually the most you'll go is maybe a year or 2 or even 5 years, depending on what the insurance policy is, right? It doesn't always last forever. So that's one characteristic that the fixed assets and other assets have in common, is that they generally do have a lifespan. But if they don't have a lifespan, that works just fine too. As long as it has the characteristics that you cannot touch it, it's going to automatically be categorized as an other asset. So on the right side here, we have examples, right? Your fixed asset could be your building, your furniture, your equipment, right? Where other assets could be your intangibles, which could be your deposits, your prepaid accounts, your rent, insurance, copyrights, etc., etc. Okay? And all of these have also another common thing. It's everything that you own. Okay? You own the cash in the bank. You own this building. Okay? You own the land that the building is on. You also own the patent, the prepaid accounts, the prepaid insurance. You have ownership on them. Okay? And that's assets. Any questions here?
No.
All right. So now we're going to talk about liabilities. Okay. Now, liabilities, okay, is going to be everything that you owe. Okay. Under accounting terms, it is not debt. Okay. It is an obligation, meaning that you are required to pay these individuals because you owe them. Okay. It is not debt. Okay, because debt could be anything, right? It could be an owed service, right? A debt could be anything in terms of, in the English dictionary, right? But in accounting terminology, we understand liabilities is not a debt. Even though, in context, yes, it is what we owe, but in accounting terms, it's an obligation that we are obligated. It's our responsibility that we owe these individuals, and our responsibility is that we have to pay them. Okay? So that's the idea under liabilities. Now, under liabilities, there are only 2 categories. Okay? 2 categories. Number 1 is going to be current liabilities. Okay? And the second one's going to be long-term liabilities, okay? So in this case, please do not refer as short-term, long-term, okay? Because that's not correct. It's current and long-term, okay? So how we categorize our liabilities is going to be based on the time and the length that we owe these individuals or owe these vendors, okay? Owe anybody money, okay? So a current liability is going to be when you owe somebody for less than a year or within a year, okay? So good example will be accounts payable, right? All those vendors that give us 30, 60, 90 days to owe them, that's a short term, right? It's a very short time period. So therefore, that's going to be considered a current liability, right? You're going to pay them within a year, or you're going to owe them for within a year, okay? Where a long-term liability is going to be anything that you owe for longer than a year, okay? So a great example of a long-term liability is going to be typically your loans, right? Because you can sign a loan for 5, 10, even 36 years, right? If you're doing a home loan. That could be anywhere from 36 to 40-year loans. those are going to be your typical long-term liabilities. Okay? So in this case, oftentimes the only thing that you would technically see as a long-term liability would just be strictly just a loan. Okay? Everything other than that that you owe is most likely going to be a current liability. Okay? Any questions here?
No. Oh,
Okay. So we are going to talk about the third one, our third permanent account, which is called equity. Equity is going to be your net worth. Okay? So the net worth of a company. All right? In this case, down below says right here, equity does not have any categories. I will test you on this. I will quiz you on this. You need to make sure that you do not select or say that there's current equities. No. Equities do not have any categories, okay? Now, the only exception to this rule is if we go on beyond small businesses. So if you move on to corporations, you have common stock, preferred stock, retained earnings, okay? So those are categories. But in this concept, when we're learning sole proprietor and small businesses only, you do not have any categories for equity, okay? But here are a few things that you will see normally under your equity is going to be capital contribution and owner's withdrawal. Okay, so when we're looking at equity, we're looking at owner's equity, right? What increases equity is going to be capital contribution, right? If you invest more of your own money into the company, that's obviously going to increase the value of your company, right? If we take away money using an owner's withdrawal, right, we take away from the company, then that's going to decrease your equity, okay? And of course, if we have income or a net income or a net loss, that will definitely affect your equity, right? Especially when you decide to reinvest your profits into your company. If you have a net income, then you increase your equity. But if you have a loss, unfortunately, you would have to decrease your equity, okay? So those are contributing factors that help equity, but they are not categories, okay? So do not confuse saying capital contribution is a category. It is not. I just put examples here, just like the other slides, right? I have the left side give you an explanation of the categories. The right side gives you examples of what those categories can be. In this case, no categories for equity. Okay. And then when we talk about income, which we know to be as your revenues and your expenses, okay? Revenues, okay, have three categories, okay? There are, not three, two. There's only two categories under income or revenues, whatever you want to refer them as. So when we talk about what income and what revenues are, it's basically all the possibilities that you are able to generate income, whether it's by selling a product or providing a service, right? So in this case, right, our main core of operations, right, when we talk about merchandising activity, our goal is to sell a product or a service. Well, in this case, we're not service, so we're trying to sell a product. So our main operating revenue is going to consist of sales, right? We're trying to sell a product. So that's our main operating core of business, which is going to be your operating revenues, okay? Then we have another category. So this one's interchangeable, whether you use other income or refer it as non-operating income. So these two, right, they're interchangeable. They mean the same thing. You could use them as two separate if you'd like. But they mean the same thing, other income or non-operating income, which basically means if it's not sales and you're generating income, right? Let's say I sell a product, right? I sell coffee, okay? But I also do delivery services and I charge my customers a convenience charge for delivering coffee to their store. Then that delivery charge is going to be considered an other income. Okay? Right? Think about when we were doing QuickBooks when we're dealing with the bank, right? If we charge our customers a convenience charge to cover the credit card fees, that's going to be considered other income. Okay? Right? If we charge our customers late fees, that isn't part of our main core of operations, right? We're selling a product, not charging customers because they're late on their payments. No, that's not our main core of operations. So all those fees and those kind of things would be considered either non-operating or other income. Okay. Then we're going to talk about expenses. So expenses, okay, are going to be any needs or necessities to operate your business, okay? Now, here's a little breakdown or kind of a better way to understand expenses. Expenses are going to be things that you either, one, spend on the company in order to operate its business, okay? So, for example, I need to pay for advertising, right? I need to spend money to buy advertising, right? That's going to be considered an expense that I spend to operate my business, okay? Another way to also use the expenses is by thinking about using items, right? When we talk about depreciation expense, right? That is how we reflect that we used the fixed asset, right? Cost of goods sold. Cost of goods sold is directly correlated to inventory and how we understand it when we use cost of goods sold, which is directly correlated to inventory, we understand it as getting rid of your items. If you sold the items, you no longer have it. And if you no longer have it, you need to get rid of it. So, that's how you break down expenses to understand it that way. Did I use it? Did I spend money to do operations? Or am I trying to get rid of it? Those are is going to be determined as your expenses. Okay? And your expenses is broken down into three categories, right? Cost of goods sold, which is directly correlated to inventory. Operating expenses, which is anything in order to operate your business, and non-operating expenses, which I do not teach in this class because this is advanced level of accounting. Okay, non-operating expenses is going to be anything that you have to pay extra or spend extra in order for you to still operate your business, but it's not directly correlated to your main core of operations, okay? So an example, okay, I'll just give you an example of a non-operating expense would be if you paid a warehouse to hold your inventory, okay? One, that's not the main core of your business. Your core of your business isn't to store your inventory, it's to sell inventory. So that's why it's going to be considered a non-operating because it's an expense that you have to do, but it isn't part of operating your business, right? What does my warehouse storage fees have to do with running my business? It doesn't, because I'm not in the operations to store my inventory. I am trying to sell my inventory. All right? So advertising, I'm not going to advertise for my warehouse. I'm going to advertise to sell my inventory. Okay? So that's what I mean by non-operating, is that it is not directly related to anything that's in the business that you're trying to do. So non-operating is an example would be if you have to pay storage fees, or we call them facility or warehouse expenses. Okay, something, a place to store your inventory that is separate from your main core of your business. Okay, so once again, any questions in regards to your income and your expenses?
No. No.
Okay, so here's a familiar page that we've seen before, right? We've seen this in QuickBooks, where this is how we determine how a flow of a transaction actually truly works, okay? Now, when we talk about a sale, right? A sale is considered a revenue, right? It's an operating income, right? In order to increase our revenues, right, we must use a credit, because here it tells me that my credit side is going to increase with a credit. Okay, I'm sorry. On my revenues, right, the revenues is the type, it tells me that in order for me to increase my revenue, I need to use a credit. Okay, same thing here for assets, right? If I'm increasing my revenues, meaning I'm receiving money, I'm increasing my assets with a debit. Okay? Now notice this. I'm increasing with a debit on my assets. But for my revenues, if I were to debit and use a debit account, it's going to decrease my revenues. Okay? So this is the reason why when we talk about understanding debits and credits, you can't refer it as increase or decrease, because it depends on the account type that you're dealing with. Okay? So as you can see, a debit increases an asset, but a debit decreases a liability. Okay? And this is how the workflow of a transaction does it work. Okay? So in this case, right, if I'm trying to understand that I am going to pay a bill off, right, I'm going to be decreasing my liability because I no longer owe people any more money. And in order to pay my liability, I have to decrease my assets because I'm using my cash money to pay off a liability. Okay? So this table here, right? I've provided it on the study sheets, or in the study materials folder. I provided a separate sheet for you to be able to print out, and this is what you're going to be using to help you out figure out when to use a debit and when to use a credit. Okay? Because when we take a look at a transaction, you need to read it and understand what is going on with that transaction. And we'll talk about transaction analysis in chapter 3. Okay? So, by using this worksheet, it's supposed to help us take a transaction and break it down into pieces that allows us to understand what is going on. Okay? So if you remember chapter 1, a business transaction should tell you what happened, how did it happen, when did it happen, and why did it happen, right? That is going to be how we analyze our source document. Okay. Now here we're also going to be talking about a normal balance. Okay? A normal balance by definition is going to be in each account, the normal balance is going to be whichever side increases in that particular account. Okay? So for example, right? My assets, they're increased normally with a debit account because in this case, the normal balance says on the positive side of which each account balance is being increased on. So in this case, my assets will always be increased with a debit. My liabilities, my credits are going to increase my liabilities. My equity, credits are going to increase equity. Revenues is going to be increased with a credit, right? And then last but not least, my expenses are increased using a debit. So the normal balance is going to be whatever side that is positive that increases in each account. So in this case, my debits usually are increase my assets and my expenses. Everything else, a credit increases. So liabilities, equity, and revenues. Okay. And now we're going to talk about the bookkeeping systems. Okay. Here in accounting, there are two types of accounting systems. Okay. We have single entry and then we have double entry, right? This is familiar because we've seen this as well in QuickBooks, okay? Now, in QuickBooks, it uses both, right? When we enter in a bill or enter in an invoice, right? As a user, we are using single entry mode. But behind the scenes, QuickBooks is doing the double entry system behind the scenes, okay? Now, here we are in accounting, we never use the single entry system, okay? Because the single entry system basically tells us we're going to be entering in a transaction on one side, okay? So, great example, right? A checkbook, right? You're going to write the check out for whatever the amount is, and that's only one place that you're recording it, right? You're not updating another account to why you wrote that check out, okay? So in this case, you're only moving in one direction when you're looking at a single entry type of system, okay? Whereas if you use a double entry system, right? This is where not only are you updating your check book, your check register, right? You're now updating, okay, well, I wrote this check out because I am paying for rent expense. Okay? So therefore, I need to increase that I spent money to pay for rent. So in this case, right, that's exactly what a double entry system does is it taps into two or more accounts. Now, the idea here is your debits and your credits are going to have a matching scenario. So if I wrote out a check for rent expense for $1,500, right? I'm going to debit my rent expense for $1,500 and I'm going to credit my checking account for $1,500 because that is the double entry system here. It's allowing me to record a transaction in two or more accounts or places. Okay? So in this case, this is the rule here. Your debits must always match your total credits. Okay? So again, this is also applied science, right? If there's an action, there's an equal and opposite reaction. Okay? So that's the same concept here. If there's a debit, you must have an equal and opposite credit in two or more accounts. Okay? Any questions here?
No.
Okay. Wow, we went over chapter 2 pretty quickly. So once again, let's recap chapter 2, right? We talked about what accounting is, right? It's a systematic way to record, process, analyze, sort out, summarize your financial data or business transaction. We talked about the accounting equation, which is your assets equals your liabilities plus your equity. We talked about the accounting model, right? Which side increases on the assets, right? It's usually your debits, right? If you were to pay money or spend your cash, you would always credit that account because you don't have the cash anymore. It's flowing out of your business, right? And we also talked about debit is always referred to as left, credit is always referred to right. We have the definition of a normal balance, which is the positive side, which increases in each account. Okay, so in this case, your normal balance for your assets and your expenses would be a debit balance. Okay. We also talked about the 5 different types of accounts: your assets, liabilities, expenses, income, and equity. Okay. We learned that your permanent accounts are going to be consisting of your assets, liabilities, and your equity, while your temporary accounts are usually your income and your expenses, right? We even broken down in each account type that there's categories. So, especially for assets, there are only 3 categories, right? Current, fixed, and other. Okay? Fixed is also referred to as property, plant, and equipment. Right? Then you got your liabilities, only 2 categories, right? Your current and long term. Equity, there are no categories, okay? Right? Saying, okay, so that an income and your expenses, they have 3 each. Okay. Okay. Any questions here? Okay, so that's chapter 2.
Can you back to the simple entry? I didn't get it so well.
Okay, so single entry. Okay. Single entry is where we only record one direction on one side. Correct. So a great example is I just wrote a check out and I'm writing it in my checkbook. Okay. So there I'm essentially just crediting my checking account because I just wrote a check out. That's only recording one side. Why did I write that check out? I don't know. I only record in my checkbook that I wrote a check.
Oh, that's all. That's
Mm-hmm.
that's a single entry that you write down your checkbook. That you take this.
Mm-hmm.
All right.
Mm-hmm. Where double entry, right? We record the transaction in 2 or more accounts. So if I wrote that check out, right, I record it in my checkbook, but I also record that why did I write that check out? So the example I use is I wrote it because I'm paying for rent.
Mm-hmm.
So therefore, I'm going to add a debit to my rent expense because I'm paying for rent.
Mm-hmm.
Okay? So that's double entry. So I'm writing my checkbook and I'm updating my rent account expense.
I got it.
Okay. Excellent.
Okay.
Okay. All right, so let's go ahead and go over the exercises for chapter 2 here. Okay. Oops. So here I'm going to make it a little bigger so we can see. Okay. Number 1. Okay. What are the 5 types of accounts?
Asset, liabilities, equity,
Mm-hmm.
revenues, and expenses.
Good. Okay. What is a main account?
There's more detail from the account. I don't know how to
Account,
spell
account,
that.
account, account. Good. Okay, so give detail. Give de. Whoa, what did I do there? Okay, give detail. Okay, to an account type. Okay, right? A main account, right, will break down the account type even further down. Okay. Now, in this case, right, which flow of direction does it go in?
Right.
Okay, no, sorry. I asked that question wrong. So in this case, a main account, right, I kind of gave you the answer to, flows in one direction, right? Okay. So then what does a contra account do?
Gives the main account more detail.
Gives the main or sub account more detail. And which way does it flow?
Left.
No.
No.
It flows.
No.
How does it flow? Like in correspondence to, like in relation to the main account. Does it flow in the same direction or does it flow in the opposite direction?
Same
Opposite. Opposite
Opposite. Good.
is a contra.
It's a contra. Good. Contra meaning opposite. Okay. Where's my comma at? And flows in the opposite direction to the main account. Okay. Number 4. What does left mean?
Debit.
Yes.
Got it.
What does
Yeah.
right mean?
Credit.
Yes, good. Okay, what is the accounting equation?
Someone mentioned asset equal is going to equal liabilities plus equity.
Yes, liabilities plus equity. Good. What are the 3 categories of assets?
Current assets, fixed assets, and other assets.
Good.
Mhm.
What are the 2 categories under liabilities?
Current. and
Current
non-current.
liabilities,
And
long term,
long term. Good. What are the categories of equity?
None.
Good. None. Hey, again, I will test you. I will quiz you. I will ask this question a million times until you guys answer none. Okay? All right, number 10. What are the categories of expenses?
operating expense,
Operating expense,
non-operating,
non operating.
and cost of goods.
Good. I'm going to put COG for short. Okay? COGS for short. Cost of goods sold. And Number 11. What are the categories of revenues?
Operating income
Mm-hmm.
and other income
Mm-hmm.
and non-operating revenues.
Yeah.
Like,
So
is it
yeah. So other income or non-operating mean the same thing.
the same?
Mm-hmm.
Mhm.
They mean the same thing. Yes. Okay. Number 12. What are the two accounting systems?
Single entry and double entry.
Single entry, double entry. Good. Number 13. What is the normal balance? So in this case, I'm looking for a definition.
Is that where all the debits and credits have to equal each other?
No.
Is the positive
The positive what?
uh, positive balance, no?
Positive balance. Good. That. Good. No, you're doing good. Which, right? That increases on a side in a specific account. Remember, it has to be the specific account.
Uh-huh.
Specific account.
Balance.
Okay. So that should be in chapter 2. It's like page like
Mhm.
5 or something like that. Okay, good. And then last, okay, I guess not last, but 14. Examples of accounts for the following exercises. So here, I give you a list of accounts. I even give you, a description of each account. And your job here is to do one or the other, okay? So part 1, right, is going to be determining which account type does it belong to. So as we know, there are 5 account types, right? Your assets, your liabilities, your equity, equity, revenues, or income, whatever you want to call it, and expenses, right? Then the second thing I'm going to ask you is to determine which category does it belong to, right? Whether it is either a current, a fixed, other, okay, long term, cost of goods sold, OI for operating income, OP for operating expense, okay, and yes, cost of goods sold, right, COGS for short. So and then of course, the last thing I'm going to ask you is on which side does it normally have a balance, okay? So again, let's go ahead and walk through each one, okay? First one is going to be your checking account. What is a checking account? It's going to be money in the bank, right? Money in the bank.
Asset.
It is yes, it is an asset, right? You own the money in the bank. Good. Now, what kind of asset would you think it be categorized as?
Is a current.
Current, because it's already in its simplest form, which is it's already in cash. Money is money, right?
Yep.
So there you go, current asset. Now, because it's an asset, what would be the normal balance be?
Increase is the debit.
It would increase using a debit. Excellent. Good. Okay. Next one's going to be an accounts payable, money that you owe to vendors. What kind of account type would that be? If you owe money to vendors.
It's an obligation, right? So it's in the liabilities.
Correct. It's a liability.
Liability. Oh, I don't know how to say.
Good. Now,
It's a short time, no? So it's current.
correct, right? You wouldn't be owing your vendors more than a year unless it's a loan, right? In this case, if you do place things on account, your normal is 30, 60, 90 days. Okay? Now, in this case, what would be the normal balance for a liability?
Credit.
Credit, right?
Yeah.
Good. Next one's going to be copyrights. Okay? A copyright is a legal documentation of ownership or right. So again, a copyright is when you own the rights to a specific, whether it's music, a picture, an image, whatever, right? You own the rights to it.
Mm-hmm. I know what it is. It's an asset.
It is an asset, good, because you own it, right?
Mm-hmm.
Good. Now, what kind of asset is this?
Is another.
It's other. Good. Because you can't touch a copyright.
Patents. Mm-hmm.
Okay.
What you say, copyright, patents, or whatever it is.
Mm-hmm. Now, what kind of normal balance would it have?
And you're supposed to. I think it's debit.
It is. Because you own it. You're going to increase your debits, yes. Or you're going to increase your assets normally with a debit. Right? You're more likely to buy a copyright than get rid of one.
Mm-hmm.
Okay. What about supplies? Okay, supplies that are needed to operate the business. Now, this could be a tricky one.
It's like equipment, no? It's like, it is.
It wouldn't be necessarily like equipment because do supplies usually have a lifespan?
I don't know. I think it's an asset.
It is an asset. That is correct.
And if it's an asset, it's current.
Yep, that's correct.
Uh,
Because
not
yeah,
stable.
if you buy supplies, right, the minute you walk out of the store, you own those supplies. Now, here, if you don't use those supplies, right, you can always go back to the store and return them.
Mm-hmm.
Instant cash. So in this case, right, it doesn't fall in other categories, right? You can touch it, so that obviously is not going to be an other asset. It doesn't have a lifespan, right? We talked about this, right? Supplies shouldn't, like, if you buy a stack of paper, right, you can't say it has a life. It's paper. So the best way to categorize it would be a current asset. Now, what kind of normal balance would it have?
Positive is debit.
Good. What about a loan? Okay, owing money to a bank, okay, for over a period of time.
That you said before. It is. I tell you what I think. Or I wait for Nancy.
You want Nancy to answer this?
I don't know. I can answer. I can tell you what I think, but yeah. You say before is a long-term liability.
Liability?
Correct. It is a long-term liability. Okay, because you're gonna own it for definitely over a year. Okay, it's very rare that you'll have a short-term loan unless it is a short-term loan. It will tell you it's a short-term loan. I know for most loans out there, the beginning would be anywhere from the 1 year to maximum like maybe even 40 years. Okay, but as far as a loan itself, unless it's specified as a short-term 6-month loan, then that's going to be considered a current liability. In this case, in general terms, loans typically would be a long-term liability. Okay? So what kind of normal balance would it have? Good.
Credit.
Yes, good. It's credit. Okay. Right? What about an accounts receivable when customers owe the business money? When you sell a product to a customer and they decide to put it on account and they owe the business money, what would that be?
Is that a liability as well?
Okay, so in this case, if it's a liability, right? Am I owing people money?
No, it is not.
Oh no, it's an asset because
It
they owe us.
correct, right? It is an asset. Okay. Now, what kind of asset would it be?
A current asset?
It would definitely be a current asset. Okay. So in this context, right, when a customer owes you money, right, they give you an IOU and say, "Hey, I will pay you back." All right. Now, in this case, they owe you the money, so that means that money can easily be, you can easily receive it by going after them and say, "Hey, pay up." Okay, so it's going to be considered a current asset because it's money that you potentially do have that's pending. Okay, so yes, it is a current asset. All right, and you can redeem it at any given time, right? If you want to go down to that person's house and just be like, "Hey, pay up for what you owe," then you can do that, right? Usually, you could receive it within the month, the week, the day, depending on what your terms are. Okay. And what kind of normal balance would a accounts receivable have?
A debit?
Yes, because it's an asset, right? It's money that you potentially do have. Okay. What about an owner's withdrawal? Okay, so taking money out from the business.
Equity.
It is an equity. Good. So OE for owner's equity. Okay.
Mhm.
What kind of category does it have?
None.
None. Okay. Now, in this case, right, what would a normal balance of an owner's withdrawal account have?
Debit.
Yes, good. In this case, this is a contra account, right?
Yes.
We're decreasing our equity
Decreasing
because we're taking money away. So in this case, excellent. It is a debit account. Where's my B? There it is. What about advertising expense?
Expenses, no?
Correct. Advertising expense would be a regular expense. Now, what kind of expense would this be?
An operating expense?
Yes, right? You would purchase advertising expense for the purpose of operating, right? To sell whatever item that you're selling, you would use marketing materials to operate your business. Okay? And what kind of normal balance would expenses have?
A debit?
Yes, right? Because we talked about the normal balance, right? Usually assets and expenses are increased using a debit. So in this case, yes, that is correct. What about a cost of goods sold? It definitely is an expense.
Expenses. Mhm.
Now, what kind? What category would a cost of goods sold?
And it's a cost of goods sold.
Correct, right? Cost of goods sold is already automatically a cost of goods sold category. Okay. And what kind of normal balance would a cost of goods sold have?
So, expenses is a debit.
Good. It would normally increase with a debit.
Expenses.
Okay. Almost done, guys, here. So, what about inventory? Inventory is going to be items that you purchase that you plan to sell.
An asset.
It would definitely be an asset, right? Now, what kind of asset would you categorize this as?
A current asset.
Yes, because once again, when you purchase your inventory, right, you can go ahead and turn it around and sell it right either the next day, the same day. You can easily convert it into cash. Good. And what kind of normal balance would inventory have?
A debit.
It would definitely have a debit balance, yes. What about land, which is property?
Asset. Oh,
Fixed asset.
Yes,
go.
it would definitely be a fixed asset, right? Because it falls under the category of property, plant, and equipment, right? It's property. Right? So then what kind of normal balance would this have?
A debit.
It would definitely have a debit balance. All right, couple more, guys. What about sales? What is sales, right? Earned money from selling a product or service.
Revenue.
Good. It would have a revenue, or you can also call it income. Okay. Now, what kind of revenue would this be, or income?
It's an operating.
Yes. I think I said by accident that OI was operating income. That's other income. So let's check out the categories. I have OI for other income. I have OP for operating. Okay. So what category would it belong to?
It's operating.
It'd be operating, okay? In other cases, if you ever get asked, it could also be sales. Because sales, I mean, that is our main core of operations, okay? So operating is correct, okay? Or sales. Now, what kind of normal balance would revenues have? Or in this case, sales?
Credit.
Yes, it would normally increase
The credit.
on the credit side. Good. Okay, so. Okay. And then let's see, what about a capital contribution, which is investing money into the company or into the business?
That's equity.
100% is equity. Good. Owner's equity, right? What kind of category would this have? None. Excellent. And last but not least, what kind of normal balance would this have?
Wouldn't that be a credit as well because the money is coming into the business?
Good. Excellent. It's increasing your net worth. Good. Okay. What about equipment? Any machinery, okay, or object to run operations.
An operating expense.
Let's do that one again.
Yes.
Equipment, which is also known as any machinery or object to run
It's an asset.
operations. Yes, it's an asset because it falls under the category of fixed asset, right? Because it's a property, plant, or equipment, okay? So here, right, I'm talking about an object to run a business, not an expense or something I have to spend in order to run my business, okay? So in this case, it is a little confusing here because I use that terminology, but the idea here is that I bought a machine or I bought some kind of object to help me run my business, okay? So the example that I had in class was I bought a printer which helps me print out invoices, which is part of the operations for my business, okay? So again, this is a fixed asset and it falls under the category of PP&E, which is property, plant, and equipment. So in this case, what is going to be my normal balance?
It's a debit.
It would be a debit. Good. Okay. All right, last four. Next one's going to be a notes payable. IOUs to other people. Okay. So this is where I give an IOU to other people.
It's a liability.
Yes, good. It is a liability. Now, what kind of liability would this technique? What kind of liability would this be?
It's current.
Okay, it can be current.
And let me see.
What did you say?
No, I was thinking about the normal balance. I think it's credit.
It is going to be credit. Now, in this case, right, the difference between for a notes payable is usually it's an IOU, right? An IOU to other people. What is so special about an IOU, right? You can always defer payments, okay? So in this case, an IOU says that you're going to promise to pay them, but you can always talk and discuss saying, hey, unfortunately, I don't have money now. Can I owe you 6 months from now? Can I owe you a year from now? You're always able to negotiate when the actual payments are due. So in this case, an IOU can also act as a long-term liability, right? Because you have the flexibility whether I could owe you for 6 months, and then when that 6 months is up, I could say, hey, can I defer my payment for another 6 months? Then that's going to be over a year at that point. So in this case, a notes payable, because it has that feature where you can defer payments, it can act as a current or a long-term account. Okay?
So let me see. Current is no more than a year, and a year, or is no more than a year?
So long-term is more than a year.
More than a year.
Mm-hmm.
So
So yes, I think it's 6 months and then 6 months, and that's exactly 1 year.
a year. So a current is 1 year, or minus than a year.
Yes, less than a year.
Less than a year, or 1 year exactly. No more. Oh, I don't know how to see that.
Okay, in general terms, it could be within a year. So if it's exactly a year, that's when you have to determine whether is it current or is it long term.
What
That
do you-
that's where you can make that decision if it's exactly 12 months, 365 days, then yes, you could either determine it as a current or a long-term liability. Now, most cases, right, if it's a loan for 1 year, you would probably most likely treat that as a long-term liability. Yes, even though it is exactly 1 year. This is the way that you categorize it is within a year. So that means a year or less.
Mhm.
Right?
Okay.
But long term is more than a year.
Mhm.
Good. All right. What about rent expense? Right? It's paying for rent, straightforward.
Would that just standard expense?
That would be, yes, that would be a standard expense, yes. Now, what kind of expense is standard? What would you normally use rent for?
As in the operating expense? You have to
Correct.
operate the business out of it?
Absolutely, right? You're paying rent for the reason to open up shop. And if you don't open up shop, then I don't know how you do business except for online. Okay. So in this case, yes, I'm paying rent so I can open up my shop and run my business. So definitely it is 100% operating. Okay. And what kind of balance would a rent expense have?
A debit?
Yes, it would definitely have a debit balance. Right, two more, I believe. So the first one is going to be delivery income. Okay, when you charge to customers to cover for delivery.
It's a revenue.
It is a revenue,
Would it be a current asset?
not a current asset, because you're charging your customers to cover for those extra charges, right? It's delivery income.
Oh,
Okay, right? We're not talking about the cash that you're receiving, on the other hand.
There are others income,
It
other revenues, or whatever.
Good, because in this case, right, I'm charging a separate charge to my customers to deliver a product, right? When my main core of the service is I'm trying to sell a product, not provide a service, right? Because we are the main operating business here is that we are selling a product, right? We're looking at a merchandising operations. So in this case, if I charge my extra to my customers for delivering stuff to them, that's going to be a service that's extra, right? That isn't part of my main core of operations, which is to sell a product. So if I'm charging my customers to cover for delivery charges, that's definitely going to be other income or it'd be a non-operating income. In this case, I only have one option, which is other income. Okay? And what would my normal balance be?
It's a credit.
It would be a credit. Good. Right. Last but not least, a purchase expense, making purchases for the business operations or inventory items.
an operating expense?
It would yes, that's correct. It would definitely be an operating expense. Okay, and normal balance.
A debit?
Good. Okay. Excellent, guys. Good job. Now, I'm going to give you a little shortcuts or a little few tips here. Best way to be able to recognize the difference between the accounts is pretty straightforward, right? Anything that has the word expense behind it, you already know it's going to be an expense, okay? Liabilities. Most common liabilities would normally have the word payable at the end of it. The only exception to that would be just loans, okay? But you'll have an accounts payable, notes payable, sales tax payable, okay? Interest payable, okay? So that's how you tell that you owe people money. As far as assets, those are pretty hard to kind of determine, except if you understand what that item is to the business, right? Do you own it? Okay, then that's the only way you'll be able to tell it's an asset, all right? Other than that, that's pretty much it, okay? Good job, guys. So right now it is exactly 3:12. So go ahead and take your 20-minute break. I'll give you an extra minute. So please be back. What is that? 3:33? Is that 20 minutes? 3:33.